All right. So now we will try and understand some more nuances around the type of payments which we are making, right? So I've been talking about that in any lease arrangement, we have to make payments which are structured in a variety of form, right? You may have to require to pay a fixed rental, or you may be required to pay a variable form of rental. Variable normally we see, let's say, if you have to pay to a retail, if you've taken a shop on a lease and then you agree with the landlord that I'm going to pay you rental as a percentage of sales, right? So there are many types of arrangements. So we will try and understand all of that in some degree of detail as it is relevant from our perspective. So when we look at an example on a fixed payment, so let's try and understand this example. Entity M and lessor A enters into a 10-year lease of an office building for fixed annual lease payment of INR 200,000. As per the terms of the lease agreement, annual fixed lease payments comprises INR 170,000 for rent and INR 30,000 for real estate taxes. Okay. So again, very quickly. So I have to make an annual lease payment of 200,000 and fixed payment of 170 and 30,000 for real estate taxes. So what are the fixed lease payments for the purpose of classifying the lease, right? In this case, the fixed lease payments are nothing but 200,000, right? Because that is what I need to make inclusive of the taxes which I need to pay. Unless, I mean, if these taxes are allowed to be offset in any other kind of tax payments which you are making, then it's you look at lease payment only as 170. But generally, the real estate taxes are not allowed to be offset, unlike goods and service tax. So the fixed lease payments are INR 200,000. Although real estate taxes are explicitly stated in the lease contract, they do not represent a separate non-lease component, as they do not provide a separate goods or service. The right to use the office building is the only component, right? There's no other service which I'm receiving. The annual lease payment of INR 200,000 represent payments related to that single lease component. Okay. So let's now look at in substance fixed lease payments, right? And let's look at another example. So entity P enters into a 5-year lease for office space with entity Q. The initial base rent is INR 1 lakh per month. Rents increase by the greater of 1% of entity P generated sales or 2% of the previous rental rate on each anniversary of the lease commencement date, right? So rent is going to increase by, so I have a fixed of 1 lakh rupees per month, and then it's going to increase by the greater of 1% of entity P generated sales or 2% of the previous rental rate on each anniversary of the lease commencement date. So what are the lease payments for purpose of measuring lease liability? So in a way here, I don't know that how much increase will happen, right? So the increase in a way is not determinable, with a degree of accuracy. So it could be 1% of my sales, or which is higher of the two, right? 1% of the entity P generation or 2% of the previous rental. So otherwise, how much I'm paying is 1 lakh rupees per month. So in a way, for a 5-year period, I'm going to pay how much? Close to 60 lakhs, right? So let's look at the solution here, right? The lease payments for the purpose of classifying the lease are the fixed monthly payment of 1 lakh plus the minimum annual increase of 2% of the previous rental rate, right? As the lower of the two, entity P is required to pay no less than a 2% increase regardless of the level of sales activity. Therefore, this minimum, which is a higher of the two, right? So 2% anyway I need to pay, which is I know. Therefore, the minimum level of increase in substance fixed lease payment. So essentially 1 lakh is what I am paying, and then I'm going to compare that with 2% anyway I have to pay, and then 1% is linked to 1% of sales, right? So higher of the two. So in a way, this is in a way is definitive. So gets minimum increase. So essentially, my rental is 1 lakh in a way into 12, and then 1 lakh 2,000 into 12 for year. This is for year one. Then I have for year two, and similarly so on and so forth for year 3, 4, and 5. So you want to apply 2% top up for each of the year to determine your total lease payment. They are actually in substance fixed lease payments. You got to be careful, right, in terms of the question as to what all is being talked about. So let's now talk about variable lease payments, right? So variable lease payments. So we talked about the fixed or in substance fixed lease payments. Now we're going to talk about the variable lease payment. The variable lease payments are something which depends upon either on an index or a rate. So if they are depend upon an index or a rate, then essentially what we're trying to say is that if that index or a rate is an observable index or a rate, then you will, when you are doing accounting for lease at inception, you will adjust, you will determine that is your total lease liability, right? Defined as the portion of payment made by a lessee to a lessor for the right to use an underlying asset, during the lease term. So I need to determine the lease term, I need to determine the identified asset, I need to determine, I should have the ability to right to use, which is direct, when, where, how, what, right? All of that I need to know. And also I should be able to generate economic benefits, right? That varies because of changes in facts or circumstances occurring after the commencement date other than the passage of time. Such payments are measured using the prevailing index or rate at the measurement date, lease commencement date for initial measurement. Lessees subsequently remeasure the lease liability if there is a change in the cash flow when the adjustment to the lease payment takes effect for future payment resulting from a change in index or rate used to determine the. So it is something which at every measurement date, if there is a change in the index, then you are required to remeasure your liability, right? And we will also try and understand how is the effect of the remeasurement in a way takes care, right? From a P&L perspective. So if the variable lease payment does not depend on an index or a rate, then they do not depend on the index and rate and not in substance fixed. Example may include based on performance or usage of the underlying asset. If that been the case, essentially, they are then recognized in the profit or loss in the period in which the event that triggers the payment occurs, right? So essentially, then you don't capitalize them, then you don't record them as a liability, then you don't record them as an asset, as a right of use asset or a right of, or an obligation to pay. You essentially, you keep on paying it as you keep on incurring. As these liabilities gets determined, you pay it and you move on and charge it to the P&L. They're like any other operating expense then which you are incurring in relation to that arrangement. All right. So we will try and understand this with the help of a few examples. Okay. Variable lease payment that depend on an index or a rate. So an entity enters into a 10-year lease of property. The lease payment for the first year is INR 1,000. The lease payments are linked to the consumer price index. Okay. So the lease payment for the first year is 1,000. Lease payments are linked to the consumer price index. That is not a floating interest rate. The CPI, which is an observable index, at the beginning of the first year is 100. And the lease payments are updated at the end of every second year. At the end of year one, the CPI is 105. At the end of year two, the CPI is 108, right? So, and we are doing it for 10 year, right? 10 year. And what was my first year is 1,000. And then at the first year, my index was 100. And then it moved at the lease payments are updated at the end of every second year. At the end of year one, the CPI is 105. At the end of year two, CPI is 108, right? So what all should be included in lease payments? As the lease commencement date, the lease payments are INR 1,000 per year for 10 years. The entity does not take into consideration the potential future changes in the index. At the end of year one, the payments have not changed because it was supposed to only change with reference to the prevailing index at the end of year two, right? So it was not supposed to change. So I was continuously paying at that rate, right? And that was my liability. The liability is not updated. At the end of year two, when the lease payment obligation also changes, the entity updates the remaining 8 lease payment to INR 1,080 per year, right? So important thing is, originally I did 1,000 rent for 10 years, and then the index moved to 105. That means it was up to 5%, but there was no change because my reference rate is not year one. My reference rate was the prevailing rate on year two. So till the time the prevailing rate on year two is determined, I am not going to change it, right? There is no estimate which is involved here. So now at the end of year two, we reached, for first 2 year, I made the payment of 1,000 to the lessor. Now here it has moved to, in a way, 108. So I'm going to multiply this and then 8% in a way increase, okay? And that gives me 1,080 from that perspective, all right? So that's how you will do this. Let's look at some more examples. Variable lease payments that does not depend on an index or a rate. So if you are dealing with a situation where it does not depend on an index and a rate, then remember what I said, that if it does not, then you essentially you account for it as an executory contract. You will you will not record a liability in advance. You will keep on measuring it, and as and when the liability crystallizes, you will account for it and then you will pay for it, okay? So entity XYZ is a medical equipment manufacturer and a supplier of the related consumables. Now, customer ABC operate a medical center. Under the agreement entered into by both parties, entity XYZ grants customer ABC, entity XYZ grant customer ABC the right to use a medical laboratory machine, okay? So there's a medical lab machine at no cost, and customer ABC purchases the consumables for use in the equipment from entity XYZ at INR 100 each. So the machine is free, whereas for the consumables, I have to pay 100 each. In a way, we see some of these arrangements commonly, in the diagnostic lab kind of industry, right? Where the chemical companies or some of the pharma companies are trying to sell their diagnostic kits, and these diagnostic centers, they get the machine in a way virtually at no rent, where they pay for the consumables. It in a way it's like pay and use, kind of a pay per use kind of an arrangement. The consumables can only be used for that equipment, and customer ABC cannot use other consumables as substitute. So you have to necessarily take that vendor consumables. There is no minimum purchase amount required in the contract based on its historical experience. Customer ABC estimates that it is highly likely to purchase at least 8,000 units of consumables annually. It is highly likely to purchase at least 8,000 units of consumables annually. Customer ABC has appropriately assessed that the arrangement contains a lease of medical equipment. So it is likely that I'm going to purchase 8,000. It contains a lease agreement. There are no residual value guarantee or other forms of consideration included in the contract. Now, question is whether these lease payments affects the calculation of lease liability and ROU asset, right? And I'm assuming now you know answer by this time that Alan will go through the answers, right? But my sense is that there is no lease liability and ROU asset because everything is in a way variable, not linked to an index or a rate. It is based on consumption, and though there is a high degree of estimate, but as I said, you don't do accounting here based on estimates. Here you will do accounting only based on actuals. And that if that actual is not linked to an index or a rate, then essentially it's like an operating cost. So how does entity XYZ and customer ABC would allocate these lease payments, right? So I'm paying 100 each, and so much it. So now what's the accounting? Let's look at an answer here. There are two components in the arrangement. One is the medical equipment, which I'm taking, and the purchase of consumables, right? These are the two things for which I'm in a way paying a composite price of 100 per unit, right? Now, even though customer ABC may believe that it is highly unlikely to purchase lesser than 8,000 unit of consumables every year, there are no lease payments for purchase for the purpose of initial measurement and lease classification. So essentially, we need to do nothing, right? Entity XYZ and customer ABC would allocate the payments associated with the future payment to the lease and consumable component of the contract, right? So now let's move forward to try and understand some of the other variables which are there in a lease contract. Other variables could be purchase option, right? Exercise price of a purchase option. So if the lessee is reasonably certain to exercise a purchase option, that amount is included, right? Now, if there are penalties for terminating a lease, right, and if I consider a lease term which is shorter, then I'm going to include that. Otherwise, I'm okay. If it is reasonably certain that the lessee will not terminate a lease, the lease term is determined using that the termination option would not be exercised. The amount is excluded. Okay. Amount is excluded. Otherwise, the lease termination penalty is included. If I believe that I'm going to terminate it, and hence then I need to include that in the determination of ROU asset and the liability. But if I believe that I'm not going to terminate it prior to the lease term in a way coming to an end, then I don't need to factor in the termination option. Let's look at other variables like residual value guarantee, right? So what is the residual value guarantee? It is essentially like you've taken an asset on lease. Let's say the cost of the asset was 1 lakh rupees, and you've taken the asset on lease for 5 years. So in a way, you give the guarantee to the lessor that the realizable value at the end of the 5 year will be less than 10,000 rupees or say 15,000 rupees. So that's the residual value guarantee, right? And depending upon the terms, you may have to include, you may not have to include. So let's try and look at this. So it's defined as a guarantee made to a lessor by a party unrelated to the lessor that the value of an underlying asset at the end of a lease will be at least a specified amount. For lessees, lease payments include amounts expected to be payable by the lessee under the residual value guarantee program. Now, from a lessor perspective, amount included in lease payment is different, okay, from that for a lessee, which only include the amount expected to be payable by the lessee, whereas for lessor, amount is receivable. So I'm going to include the amount which is receivable from a lessor perspective, right? Whereas for lessor, the amount is receivable. So I think, and we will try and understand the accounting nuance of this. So let's try and understand this with the help of an example. So an entity enters into a lease and guarantee that the lessor will realize INR 20,000 from selling the asset to another party at the end of the lease. So how much I'm going to realize? 20,000, right? Now, at lease commencement, based on the lessee estimate of the residual value of the underlying asset, the lessee determines that it expects that it will owe INR 8,000 at the end of the lease. That means what? That I'm giving a guarantee of 20,000, but I will only be able to realize 12,000. 8,000, I'll have to cut a check and give additional, right? So that's this 8,000 in a way, owe 8,000 at the end of the lease. I'm giving a guarantee of 20,000. The lease should include a state payment of 8,000 as a lease payment. And we just saw that, right? The answer to that is yes. So the lessee should include the amount of INR 8,000 as a lease payment because it is expected that it will owe the same to the lessor under the residual value guarantee, right? Now, remeasurement of lease payment. So we have to look at also the remeasurement. We talked about this. If it is linked to an index or a rate, then I need to remeasure that at every, in a way, whenever those measurement dates are due, so to say. And there could be some other scenarios, right? So it could be because of the change to lease term. It could be because of the if there is a change in the repurchase option or renewal option, right? A change in the assessment of whether a lessee is reasonably certain to exercise an option to purchase, right? A change in the amount expected to be payable under a residual value guarantee. So in the previous example, you saw 8,000. Now, let's say you realize that I may have to pay 10,000. So you got to make an adjustment from that perspective. We talked about the change in the index or the rate, right, to determine those payments. And in relation to the in substance fixed payment. So in that example of 2%, 1%, assuming, let's say, in 1 year, if that sales were higher and that got triggered, then by default, every subsequent year, because the baseline itself has changed, right, it will have an impact. And then if there is a lease modification, that is not accounted for as a separate lease as part of a modification accounting, right? So that is where, or in all scenarios, it will result into the repayment of remeasurement of your lease obligations. Let's look at when happens in the case of lessors. So a change, lessor will do only when there's a change in the non-cancelable period of a lease, right? A change in the non-cancelable. So if you modify the agreement and change that, then only you need to look at the remeasurement from a lessor perspective. And we will try and understand a little bit more that to lessor accounting continues to be guided by the existing principles, which is your finance lease, operating lease. And as I said, from a lessee perspective, that has been done away with. And it's a single lease accounting model from a lessee perspective. And hence, this has become much more different, right, or complex, or a lot more factors to be considered, from a lessee perspective. Let's look at a scenario where a lessee gets involved before the commencement date. And remember, we talked about the inception date and the commencement date, right? So commencement date is the date when you actually determine your ROU asset and a liability, right? Inception date is the date when you actually sign the contract and get an agreement on all the terms and conditions, right? So an entity may negotiate a lease before the underlying asset is available for use by the lessee. Thus, based on the terms and conditions of the contract, a lessee may be required to make payments relating to the construction or design of the asset, right? Based on the terms and condition, a lessee may be required, right, to make payments relating to the construction or design of the asset. We do experience in some scenarios. So costs relating to the construction design of an asset are accounted by applying other Ind AS. Okay, they are like leasehold improvements. Okay, they are like leasehold improvements. They are not, so to say, are lease assets, right, or right of use asset in a way from that perspective. The lessee may obtain legal title to an underlying asset before the title is transferred to the lessor and the asset is leased to the lessee. If the lessee controls of the underlying asset before that asset is transferred to the lessor, the transaction is a sale and a lease back transaction, right? It's a sale and a, so essentially, if I was the owner of the asset and then I was getting some things done, and then essentially I sold this, I transferred the title to the lessor and then I've leased it back. That's nothing but a sale and a lease back transaction. Otherwise, if the lessee obtains legal title to the underlying asset but does not obtain control of the asset before it is transferred to the lessor, the transaction is not accounted for as a sale and lease. It is rather accounted as a lease. So if you never had control, then that means you were never in substance the owner of the asset. Then there is no question of this being the lease arrangement, this being the sale and lease back. Then this was vanilla lease agreement, right? So again, I want to emphasize that the standard is a lot more focused, right, on the substance of the arrangement. So you got to be guided by the substance of the arrangement and not by the form of the arrangement, in a way, from that perspective. So we need to be mindful that we're looking at substance over form from an accounting perspective. Okay. So let's now, some of the other payments which a lessee may incur is a direct cost, initial direct cost, right? Which I may need to pay, which are nothing but my agreement cost, legal diligence cost, and some of the other costs which otherwise I wouldn't have incurred. So initial direct costs are defined as the incremental cost of obtaining a lease that would not have been incurred if the lease had not been obtained, except for such costs incurred by a manufacturer or dealer lessor in connection with a finance lease. So what are the examples? That includes your commission paid to include payments to employees acting as selling agents. So I pay to brokers and all, legal fees which I pay resulting from the execution of lease. Lease document preparation cost incurred before the execution of the lease. And then if I were to also make payments to certain tenants, to move out, and then if I'm paying certain costs in relation to guarantee of a residual asset by an unrelated third party. All of them are examples of the cost which I need to include. What is it I need to exclude? Employee salaries, which I have to pay irrespective of the fact that whether there is a lease arrangement or not. Now, if I have to pay a bonus, right, which is linked to successful closure, that becomes an incremental cost. Legal fee for services rendered before the execution of the lease, it is not incremental. Negotiating lease terms and condition, advertisement, depreciation, all of them in a way are to be excluded, right? What is to be included? Commission, legal fees, document preparation cost, amount paid to the tenants, and consideration paid for a guarantee of a residual asset. So all these I need to include. These I need to exclude from an initial direct cost, right? That's what we need to remember. Moving forward to talk about the discount rate. So what are the discount rate which you need to use for the purpose of determining your right of use asset as well as the obligation, and that discount rate is common. You don't need to use a different discount rate for asset and liability. You use the same discount rate, okay? Same discount rate for the asset and the liability. Discount rates are used to determine the present value of lease payments, which are used to determine right of use asset and lease liability in case of lessee, and to measure lesser net investment in the lease, right? If it's a case of a finance lease from a lessor perspective, okay? So what we're trying to say here, you're going to determine the discount rate, and then you're going to apply that discount rate to your lease payments to determine your right of use asset and present value of lease liability. So from a lessee perspective, the discount rate to be used should be, right? So there are basically, if the discount rate is known as to what is the discount rate which is used by lessor, which is the rate which is implicit, then that is what you will use. If that rate is not available, then you will use the lessee incremental borrowing rate. So the interest rate which is implicit in the lease, if that rate can be determined, or if that rate lessee, if not, in the lessee shall use the lessee incremental borrowing rate. See, the principle around this is based on the fact that if I am the lessee, right, if I am the user of that asset, so at what rate probably I could have borrowed money to purchase that asset, right? Instead of deciding to purchase that asset, I've decided to lease that asset, right? So if I were to purchase that asset, then I need the funds, right? Now if I need the funds, at what rate I can potentially borrow the money? That's why it's a lessee incremental borrowing rate which is to be used, not the lessor borrowing rate, because lessor rate may be 3%, 4%, but when lessor is giving it to you, the lessee, the lessor also want to price in the interest rate risk, right? Which is relevant to the lessee, not to my, basically, because I want to make money on the transaction. If I can borrow, if the lessor can borrow at the rate of 5%, if I were to transfer the property at the same rate, then I will not make money. If my lessee, in a way, if they can borrow money at the rate of 7%, then I'm going to also charge them 7%. So that's why you take the lessee incremental borrowing rate. So if you know the interest rate, which is the rate which is implicit in the lease, then you take that. Otherwise, it's in most of the cases, right, in 95% of the cases, this is what we end up using. This is which is the lessee incremental borrowing rate. Very rarely you will know that what is the interest rate implicit in the lease. Of course, in an examination setting, this information may be available in a question paper. If that been the case, that's the first preference. Okay, if that's not available, then you get to this, right, in terms of the discount rate. Let's looking at from a lessor perspective. Lessor use the interest rate which is implicit in the lease, which is the present value of lease payments made plus your unguaranteed residual value, which I expect to realize, equals to my fair value of the underlying asset, right? So whatever is the present value of lease payments, this include also the guaranteed residual value, right? Now, there are scenarios that the residual value guarantees is this, there is no guaranteed residual value, then I'm going to figure out how much is my unguaranteed residual value, because that also is a factor which I assess in terms of my total project profitability, and that's what I'm going to use to determine the fair value of the underlying asset. Okay, and then I'm going to also look at the initial direct cost of the lessor, right? So the lessee uses the incremental borrowing rate when the interest rate implicit in the lease cannot be readily determinable. And lessee incremental borrowing rate is the rate of interest that a lessee would have to pay to borrow over a similar term, and a similar security, similar term and with a similar security. The fund necessary to obtain an asset of a similar value to the right of use asset in a similar economic environment from that perspective. Okay. Now let's try and just kind of recap quickly from a discount rate perspective. Very, very important for us to understand this from a lessee perspective. I'm going to use it. The interest rate which is implicit in the lease arrangement. Now, if that is not available, then I'm going to look at the lessee incremental rate of borrowing, right? And when do I need to revise them? The discount rate, I need to revise the discount rate only when there is a change in the lease term, when there is a change in the assessment, whether the lessee is reasonably certain to exercise an option to purchase the underlying asset, a change in the floating interest rate, if that result in the change of lease payments, a modification that is not accounted for as a separate lease. So I think the important point here is that once you have determined your right of use asset and the right of use liability, you don't need to change it for that lease term, okay, which is 5 years, 6 years, 10 years, for example. These are then assets and liabilities determined. You keep on unwinding them, the liability, and we'll try and understand this with more examples, and you keep on recording the asset amortization. Okay. However, if there is a change in the lease term, that in a way warrants the reassessment of the discount rate. If there is a modification in the lease contract, that in a way warrants the reassessment of the lease term. So now, if let's say if it is linked to an index or a rate, for example, and that resulted into change in the lease payments, that may warrant reassessment of the discount rate in a way which is prevailing on that day. So whenever you're going to reassess it, on that day, possibly you'll have to also look at the discount rate, right? Now, from a lessor perspective, the vision is not applicable since lessor do not remeasure lease payment using the revised discount rate upon lease modification, of course, of the lessee. The lessor either applies Ind AS 109, which is the finance lease, or treats a modified lease as a new lease from an operating lease perspective. Let's now talk about a little bit more on the economic life, right? So there is a difference between economic life and useful life, right? So what is economic life? Economic life is the total life of the asset, okay? Useful life is what I believe, the user of the asset believe, is that, I'm going to use it for, from my perspective, right? And then of course there could be another scenario, is what is the term of the lease, that can be again be shorter, shorter than the useful life, for example. Okay, so let's try and understand what's the definition of economic life. Period over which an asset is expected to be economically usable by one or more users. Try and understand here. It's one or more users, not necessarily the lessee only, right? It could be lessee one, lessee two, lessee three. If that asset can be used by the total period over which it is economically feasible in a way to use that asset, or the number of production or similar units expected to be obtained from an asset by one or more users. So whether you look at it by a production method or by look at a life method, in a way, so over what period you can use it or how much you can use it to produce, in a way, from that perspective. So let's try and look at a quick a recap of what all we've talked about. So we've talked about the separation of the lease and non-lease component. We understood that in an arrangement, what's the lease component and what's the non-lease. So non-lease, which does not relate to the charges I'm paying for the use of the property. It is in a way for the services which I am receiving. And then we saw how you separate them. Then we also saw that you have an accounting policy choice, which is a practical experience not to separate them and combine them. And then we also picked up an example of a real estate taxes, which we said that is not a non-lease, and you got to continue to treat them as a, in a way, single lease component. We talked about the contract combinations in a way, which we said that if you're signing multiple contracts at about the same time, then you got to look at them together, right? And when you look at them together, when let's say one contract is not relevant along without having the other contract in place, when all of these have to work together cohesively for the vendor and the customer in a way to benefit out of those arrangements, and they are signed at about the same time, right? They are economically integrated even though they are signed differently. So I need to evaluate, do I need to combine? We talked about the difference between the lease inception and the commencement. Inception is when I'm signing the contract, when I am clear on the terms and condition, but I've yet not taken the possession of the property. Commencement is when I'm actually taking the possession and I have a right to use. From that day onward is the commencement. On that day, I'm going to determine my, lease asset, right of use asset, and the lease obligation. Use the discount rate prevailing on that day. On that day, I'm going to determine my lease term, so on and so forth. So then we talk about the lease term, right? What is the lease term? Is we remember lease term was the non-cancelable period, and then the renewal period, which are reasonably certain, right, to be exercised from a lessee perspective. And then we talked about if the termination options are in the control of the lessor, then that is considered as a non-cancelable. If both party can terminate, then anyway that doesn't matter. If the lessee can terminate, then lessee has to make an assessment that am I reasonably certain to renew or to terminate. And then we also saw an example where there was a significant amount of leasehold improvement being done, and then that existence of the leasehold improvement in a way was a significant economic disincentive for the lessee to terminate, and hence it was presumed that the lessee will renew the leasehold, the lease arrangement, right? We talked about certain recognition exemption, right? Recognition exemption for short-term leases, right? Which is short-term leases are leases which are less than 12 months, right? But let's say you are doing an 11-month and then you are reasonably certain that I'm going to renew it, then that will not qualify as a short-term lease, okay? So short-term leases which are less than 12 months in a way, which you don't expect to renew, then you may decide not to account for this under the lease standard, or for low value items, right? And again, for low value items, we said the the standard is in a way silent as to the monetary threshold, and as an organization one needs to decide and then apply that consistently based on materiality assessment in a way for that organization. So then we talked about lease payments. Lease payments are a variety of forms. You may make a fixed payments, in substance fixed payments, variable payments. Then you have residual value guarantee. Then you may have initial direct cost. Then you may also have purchase options, which you expect to exercise. So all of that is what you need to make a careful evaluation as to what all you need to include, and especially on the initial direct cost, we saw that some needs to be included and some needs to be excluded from the perspective of your total determination. Then we talked about the residual value guarantee. So whatever is your residual value guarantee which you have, which you made under the arrangement, and then let's say you made a guarantee of 20,000 and you expect to recover only 12,000, that means 8,000 is the check, is what you need to cut. That 8,000 then needs to go into the right of use asset in a way from that perspective, and needs to be accounted for. We talked about the initial direct cost, that what needs to be included. For example, the commission which you are paying, that needs to be included. The legal document preparation cost, that needs to be included. What needs to be excluded, right? You need to exclude the employee salary cost, for example, that needs to be excluded. Any legal cost which you incur when you are not sure that you want to get into this arrangement or not. So those type of costs you need to exclude. But once you have made up your mind, look, this is what I want to do, any subsequent cost after that in a way is an incremental cost. In a way from that perspective. We talked about the discount rate. So what's the discount rate you need to use? You need to use the discount rate from a lessee perspective, is the interest rate which is implicit in the lease, or the my incremental borrowing rate, the lessee incremental borrowing rate. So if the interest rate implicit in the lease is not available, then you will use the incremental borrowing rate, right? From a lessor perspective, right? We talked about, again, they will use the same thing. And they need to determine this with reference to, and this is relevant for them only in the case of a finance lease, right? And then finance lease also, which is where I'm going to record a net investment in the lease, and I'm going to de-recognize that asset, and so on and so forth. So and that's where you got to look at the present value of lease payments plus your unguaranteed residual value. That will give you your fair value of the asset, and that's how you will determine. So from a lessor perspective, there's some more in a way complications, whether you are a dealer or manufacturer, or you are simply a financer, and so on and so forth. Then you look at the economic life. Economic life is what we discuss, is that over which the asset can be productively used, economically feasible to be used by one or more users, or economic life is the number of units which an asset can be used to generate. And that becomes a benchmark in a way more from a lessor perspective to determine that, whether the asset which I've leased out, is that a finance lease or an operating lease. From a lessee perspective, it generally doesn't matter, because that's no longer a relevant criteria for you to determine in a way the total with the classification. It's a single model, right? And so essentially you are more focused from a lessee perspective to determine the lease term. So from a lessee perspective, I need to get the lease term right for me to determine my right of use asset and right of use, and my obligation. So now essentially we have, we talked about all the relevant concepts, right, which are relevant beyond, other than, things around lease modifications, which we will cover in a while, right? But other than that, broadly, we've covered all the key concepts here. And now I'm going to talk about the real accounting, right? How do all of this, whatever we picked up so far, I need to apply, or we need to apply from an accounting recognition and measurement perspective, okay? So now we're going to look at, there's some examples from a recognition and measurement perspective, the principles and so on and so forth. So When you look at a recognition and measurement, right, a lessee is defined as an entity that obtains the right to use an underlying asset, right? So there has to be, in a way, underlying asset, there has to be a right of use, and then a period of time, right, which is the lease term, and then I need to pay a consideration, right? Now, when you look at the recognition, right? So when I need to recognize at the lease commencement, right? And yes, 116 requires lessees to recognize a liability, right? To make these payments, to make lease payments. And an asset representing the right of use, the underlying asset, the right of use asset during the lease term for all leases, except, as I said, for short-term leases or for lease of low-value item, where you decided to take the exemption. Now, from a measurement perspective, lease liability is measured at the present value of remaining lease payment to be made over the lease term. So I need to know the lease term. I need to determine the present value, and right of use asset is measured at cost. You don't do accounting for this at fair value, so to say, right? It is accounted for at cost. Okay. So initial measurement, lessee initially measures the right of use asset at cost, which consists of all of the following asset. I'm trying to measure the asset here, which is what is my present value of lease liability, right? Plus the initial direct cost, right? Plus initial direct cost. Remember, we all talked about these are costs which I may have already paid, right? So I'm going to add whatever I need to pay, which is lease liability, plus my initial direct cost, which I have incurred, plus my cost to dismantle, remove, or restore, measured in accordance with Ind AS 37, right? Plus, if I made any advance payment, right? Prepaid, prepayment, lease payments, example, deposit. So deposit, normally what happens is that, let's say if you've given a deposit which is interest free, right? So essentially what you will do, that deposit, you will discount it to the present value, and the difference between the present value and the gross amount which you paid, that delta in a way gets added to your right of use asset, minus the lease incentive received. If you've received any lease incentive, that you need to, of course, reduce, and all of that in a way gives you a right of use asset. Okay, so what all goes into your right of use asset? It is your lease liability plus your initial direct cost, plus your cost to dismantling, plus your prepaid lease payments, minus your lease incentives, and that gives you a right of use asset. Right of use asset. From that perspective, how that has to be presented in the financial statement, a lessee apply a single lease accounting model under which it declares all major leases on balance sheet, right? It's a single lease accounting model. From a balance sheet perspective, on the asset side, I'm going to record a right of use of underlying asset. On the liability, there's an obligation I'm going to record. From a P&L perspective, there is a depreciation and interest cost. Interest cost I need to record in relation to the unwinding of the lease liability, right? Unwinding of lease liability. Okay, and depreciation is in relation to the amortization. Here it is amortization. So there are two costs which comes, and again amortization over the lease term. Okay, so I'm recording the amortization over the lease term, and the interest, there is an unwinding of lease liability of the interest. That's how these two things has come as the P&L charge. This comes as part of your after EBITDA, as part of your EBIT, and this is actually as part of your interest cost, right? This is as part of the interest cost. Now this interest cost is also eligible in a way if you have a qualifying asset under Ind AS 23 model, as we talked about, it is an interest cost, and if you're qualifying asset, and then you can potentially look at capitalization of this interest as well, right? If you have a qualifying asset on the right hand side of your balance sheet. So looking at the measurement of the lease liabilities, right? That's the first thing we had on the asset. So how do you measure a lease liability? Let's look at this with the help of an example. Entity L enters into a lease for 10 years, right? With a single lease payment payable at the beginning of each year. So I have to make a single lease payment at the beginning of each year. The initial lease payment is INR 100,000, which I've already paid at the beginning of year one. And this is a 10-year lease contract. Lease payment will increase by the rate of LIBOR each year, right? It's an observable index or a rate. At the rate of commencement of the lease, LIBOR is 2%. LIBOR is 2%. So it will increase by 2% every year, right? That's the initial date. Okay. Initial lease payment is INR 100,000, will increase by the rate of LIBOR each year, right? At the date of commencement of the lease, LIBOR is 2%. Assume that the interest rate implicit in the lease is 5%. How lease liability is to be measured, right? Assuming that the interest rate which is implicit in the lease is 5%, how will you measure the lease liability for a period of 10 years? For a period of 10 years, right? So essentially, how am I going to go about this, right? If you think about it, year one is already been paid, done and dusted, no discounting, 100,000 is done. Now I'm going to start looking at it from year two onward, which I need to pay 100,000, 100,000, 100,000 for next 9 years. I'm going to discount them by 5%, and then I'm going to top it up 2%. Essentially, it's a discount of 3%, right? That's what looks like. Let's see. In the given case, the lease payment depend on a rate and hence is included in measuring lease liability. As per Ind AS 116, the lease payment should initially be measured using the rate as at the commencement date, right? So LIBOR at that date is 2%. Therefore, in measuring the lease liability, it is assumed that each year the payment will increase by 2%. The lease liability initially measured at INR 8,80,887, right? 8,80,887, which is as follows. All right, so let's look at some more details. So year one, that's the chart which comes 100 lakh, which I've already made. Then I'm going to do at the end of year 202, and then I'm going to apply 2% on that, 2% on that. So you simply keep on adding at the rate of 2%, at the rate of 2%. On all of this, it gets to 119. And now I'm going to discount it by 5%, right? Now, year one, I need to do nothing because that's paid at the beginning of the year. Had this been at the end of the year, you need to make this payment, then that was also supposed to be discounted. Okay, remember. So the fact patterns are very, very important. So year one, nothing changes. Then I'm going to discount it by at the rate of 5% and then 5%, so on and so forth. And that's also, this number is 8,80,887. All right. That's the way you need to do the computation. This is step one. Okay. This is step one. And then this is step two. Discount factor is already provided for, so you don't need to apply yourself. And this is the present value. This is the outcome in a way, step three. Okay. And that's your total liabilities, right? Present value of future lease obligation. Okay. Let's move forward to understand the, we talked about how do you measure the liability. Now we're going to talk about how do you measure the right of use asset. And remember what all goes into right of use asset. We said the present value of lease obligation. Then we have said any upfront deposits which you have made, present value of difference of that, then we've said initial direct cost, which needs to be added, any advance payment, if at all you have made, right? And then we said you got to reduce your lease incentives. If you have any lease incentives that you need to reduce. So all of that in a way we need to remember. Let's try and see with the help of this example. Entity Y and entity Z execute a 12-year lease of a rail car, 12-year, right? So I know the lease term 12-year with the following terms on January 1, 2016, right? The lease commencement date is February 1, 2016. Okay, all right. entity Y must pay entity Z the first monthly rental payment of INR 10,000 upon execution of the lease. So 10,000 I have to pay upfront. Then entity Z will pay entity Y INR 50,000 cash incentive. So I'm getting a 50,000 cash incentive to enter the lease payable upon lease execution. Then entity Y has incurred INR 1,000 of initial direct cost. So, just try and understand what all is going on here, right? So I have to make an upfront payment here. There is an upfront payment. Okay. Then I have received a lease incentive. Okay. Then I have initial direct cost. Okay. And then I need to calculate and then the term was, it's a term is 12 years. Okay. And must pay the first monthly rental payment of INR 10,000 upon execution of the lease. That means every month the monthly rental is 10,000. Okay. Now, entity Y calculated the initial lease liability at the present value of the lease payment, discounted using the incremental borrowing rate, because the rate implicit in the lease could not be readily determined. The initial lease liability is INR 8,50,000, right? The initial lease liability is also given is 8,50,000. That information is also given, the initial lease liability. This information is also given, right? Now, how would lessee company measure the initial right of use asset? Okay, so try and understand. I know what is my present value of lease liability, then I paid this upfront, then I've received this incentive, and I've incurred this direct cost. All of that is what you remember. We need to adjust in a method to get to my right of use asset. Okay, so when I look at the solution here, so I'm going to look at my lease liability as 8,50,000. I'm going to increase that by 10,000. I'm going to reduce that by 50,000. I'm going to increase that by 1,000, and the total number is 8,11,000 as my initial measurement of right of use asset. Okay, the lease incentive which I receive 50,000, that has to be reduced. Okay, everything I need to add, this I need to add, and this I need to reduce. That number gives me 8,11,000. Okay, that's the right of use asset. So this is reduce. Okay, this is reduce. All right. So moving forward, now we're going to talk about the subsequent measurement of right of use asset. This was the initial measurement. Initial measurement ordinarily will not change, right? Unless there's a change in terms and conditions, or if it is linked to an index or a rate, as I said, and if those index or a rate itself changes on the remeasurement date. So models used for remeasurement after the commencement date, the right of use asset should be measured using a cost model, unless it applies a revaluation model as specified under Ind AS 16, and that is generally not available because this being an intangible asset. Under the cost model, measurement is done as cost less accumulated depreciation and accumulated impairment loss, adjusted for remeasurement of lease liability. So if you're remeasuring the lease liability, then that gets also added in a way to right of use asset. The depreciation, I'm going to depreciate in accordance with Ind AS 16, subject to if the lease transfer ownership of the underlying asset to the lessee by the end of the lease term, or if the cost of the ROU asset reflects that the lessee will exercise a purchase option. The ROU asset should be depreciated from the commencement date to the end of the useful life. Okay, so in a way, if lessee is going to be the owner, eventual owner of the asset, which is the case of a finance lease, then you're going to depreciate this over a finance over its useful life the way you normally do it for your owned asset, like under Ind AS 16 model. Now, if you don't believe that the lessee is going to be the owner of the asset end of the day, then you're going to depreciate it over shorter of the useful life or lease term, whichever is shorter, right? Otherwise, we depreciate it to the earlier or the end of the useful life and the end of the lease term, right? So that's how you will depreciate it from a P&L perspective, and we will again try and understand this with the help of some examples, right? From a lease liability perspective, when do I need to subsequently remeasure this? Let's try and understand this. Lease liability is accreted using an amount that produces a constant periodic discount rate, the discount rate which was used originally, right, on the remaining balance of the liability, right? So you will not keep on changing just because the market discount rates are changing unless there is a remeasurement event, right? So when do I need to remeasure this? Should be accounted for a manner similar to other financial liabilities, right, on an amortized cost basis. Now, lease payment reduces the lease liability when paid, okay? So if you're making a payment, then you keep on reducing the lease liability. Thus, after the commencement date, a lessee shall measure lease liability, okay, by increasing the carrying amount to reflect the interest on lease liability, reduces the carrying amount to reflect the lease payments made, right? So I'm going to increase it with the interest, which is unwinding of the discount, right? And then I'm going to reduce it by the cash which I paid out, right? And remeasure the carrying amount to reflect any reassessment or lease modification, or to reflect revised in substance fixed lease payment. If there are any way modifications or changes or triggers, then I need to revise it. Otherwise, the lease liability is simply accounted for on an amortized cost basis, okay? Simply accounted for on an amortized cost basis, okay? So let's look at the expense recognition from a subsequent measurement perspective. So lessee will recognize the following item in expense for leases. Okay, what are those items? Depreciation, we talked about depreciation of ROU asset and interest on the lease liability. That is going to go into my P&L, which is, if I'm the owner of the asset, then I'm going to in a way amortize it over the useful life. If I'm not going to be the owner, then I'm going to amortize it over the shorter of the useful life or the lease term, right? And then I'm going to unwind the interest rate, right? Unwind the discount, which is parked as part of my lease liability. So every year that interest cost is going to get charged. So essentially, interest expense decreases as cash payments are made during the lease term, leading to a front loading of expense recognition pattern. Okay. Now, when you look at variable lease payment, okay, so after the commencement date, any variable lease payments not included in the measurement of the lease liability in the period in which the event, or so variable lease payments, as I said, are not included. So you will deal with them as and when it goes on, unless it is linked to an index or a rate, right? Any variable lease payment not included in the measurement of the lease liability in the period in which the event or condition that triggers those payments occur are recognized. So if they are not included, then you will record them on an ongoing basis. You may have to impair the ROU asset under the Ind AS 36 model. And when do you impair an ROU asset? When you believe that you will not be able to generate sufficient future economic benefit with comparing it to the carrying value of the asset. You will follow a similar principle, and then which is, highest and best use. All of that is what you look at, which is the recoverable amount and the value in use. You will compare with both of them, and if the carrying value is higher as compared to the higher of the in use or in exchange, which is the recoverable amount, then you have to possibly record an impairment charge. If ROU asset is impaired, an impairment loss is recognized, and ROU asset is measured at its carrying amount immediately after the impairment, then the depreciation charge is also in a way being revised for the future period, right? So let's take an example to further, in a way, understand all of these concepts, right? So entity ABC, lessee, enters into a 3-year lease of equipment. It's a 3-year contract. Now, entity ABC agrees to make the following annual payment at the end of each year. So I'm going to make the payment at the end of each year, right? INR 20,000 in year 1, 30,000 in year 2, and 50,000 in year 3. So these are fixed payments which I need to make, 20, 30, 50. Okay. Now, for simplicity purpose, there are no other elements to the lease payments. Assumed a discount rate of 12%, which is my incremental borrowing rate. Entity ABC depreciates the ROU asset on a straight line basis over the lease term. Okay, so I've got several things, right? Lease term, 3 years. I've got the discount rate, 12%. Okay, and then I've got the payments, lease payments detail I have. Okay, which is what I have it here. Now I follow a straight line method. Straight line method in a way for depreciation. Okay. Now the question is, how would ABC account the initial and subsequent recognition of ROU asset and the lease liability under Ind AS 116? So what do I need to do here? I'm going to record, I need to first determine what is my present value of lease liability, right? The present value of lease liability is nothing but 20,000 plus 30,000 plus 50,000. I'm going to discount it by 12%. That it gives me the present value of the lease liability. Since I have no other factor here, that also becomes my right of use asset. Okay. And then I'm going to amortize that over a 3-year period. Okay, so let's just try and understand this. How do I need to look at this? So initial recognition, step 1, at the commencement date, entity ABC would recognize the ROU asset and the corresponding lease liability, which is 20,000, 30,000, 50,000. I'm going to discount because this was made payment at the end of the year, right? That's why I'm discounting by 12% all three, and that number comes to 77,364. That's my present value of liability, and that, since I have nothing else to adjust here, there is no lease incentive, there is no direct cost, there is no in a way residual amount or anything like that. So I am going, there is no upfront payment, there is no deposits here. So I'm going to record this also as the ROU asset. Okay. Now, how do I now need to deal with this? So this is my ROU asset and my liability. Now I'm going to look at how do I need to deal with this from an P&L perspective, right? So schedule for lease liability and ROU asset. Okay. Now I'm going to look at year 1 to 3. So that's my liability at the beginning of the year, 77,364. Then I'm going to make the payment of 20,000 because that's what the payment I'm making, 20,000, 30,000 and 50,000. That information is in a way available. So I'm going to then unwind the discount, which is 9,284, which is nothing but 12% on 77,000, which is accreted at the rate of 12%, right? My closing balance is 66. That becomes my opening balance, and I make a payment of 30,000 on 66. I'm going to, in a way, record at the rate of 12%. That comes to 7,998. This is my revised balance, and then this my opening balance, and then I make a payment of 50 on this. Again, at the rate of 12% per annum, it becomes 5,005. That it becomes 0. That's how. So this is the accounting which I am doing. This is for the table. We will just quickly explain as to how this needs to be recorded in the P&L. So this is nothing but my interest expense. Okay, this 9,284, the 7,998, and 5,354 is my interest expense. Now, when I'm going to look at the ROU asset, right, I need to amortize ROU asset doing what? Straight line, right? 77,364 divided by 3. My annual amortization charge is divided by 3, and is this 25,788, right? Now, how do I account for it from a P&L perspective, right? So I'm going to look at ROU asset to ROU liability. Then I'm going to look at interest expense, which is year one, 9,284, and to year two, and again to lease liability, right? Then I'm going to look at, my P&L charge, which is depreciation of 25,000 and my cash flow of 20,000, which is going out. So that's how. So that's the entry you're going to pass in year one. The similar entries you will be passing in year two and year three, right? So again, I'll go back to just help you understand year one, right? What is I'm doing? I'm going to recording the ROU asset 77,364 and ROU liability 77,364. Okay. Then I am recording the interest, which is my year one interest. That's an interest expense, and I'm going to increase by the lease liability by that amount. And then I am going to record my depreciation, which is a straight line amortization, right? Straight line method. And then I'm going to adjust my lease liability because I'm going to pay 20,000 rupees, and then I'm going to record similar entries in year two and year three. So now when you look at the end of the year three, right, all of this will get to zero. So you started here 77,364 of ROU asset and liability. Then these are the payments I am making. This is the interest cost which I'm recording, and this is the amortization. So I'm charging, and these are the revised. This is the P&L cost, total P&L cost, which is nothing but the amortization plus the interest. And that's my ROU asset after the amortization. That's my liability. Remember, just see this. In year one, you started, both were similar value. But in year two, the liability is higher, the asset is lower because, again, because here the payment is in a way backloaded, so that you're making larger payment in year three, so that means your interest charge is higher, and this number anyway only will be same in at the inception. The moment you move to year one and the end of the year one, this number will be different because your depreciation and your payment and interest accretion, they are not in a way similar because of the different methods being used to compute each of them. So you are recording here the amortization. Here I am recording the payment as well as I am. So this 66,000 has come in a way nothing but which is 77,000. 66,000 has come by 77,364 in a way plus 9,284 minus 20,000, right? Which is the payment which has been made here. Okay. Similarly, this 44,646 has come, which is nothing but 66,648 plus 7,998 minus 30,000, which is the payment which has been made. Okay, that comes the and similarly in end of the year three, because you made the payment of 50,000, it is nothing which is left. So in year three, everything gets reconciled to 0, but in the intermediate period, there is a lot of movement and impact which you need to compute. I hope this example has given you a good perspective in a way on the life cycle of the whole lease accounting, right? At the inception, then year one, then year two, then year three, how you need to compute the right of use asset, the right of use, the obligation, and then amortization, the interest accretion, and all of that. Of course, there could be added complexity to this if you were to add, let's say, a modification in the in-between period, a change in lease term, so on and so forth. So you can keep on complicated, but remember the facts, right? If you remember the facts and understand the principles, you will be able to apply this as you look at the computation. So quickly to revisit what we've talked about, right, in this section. So we have a right of use asset and a liability at commencement, right? Amount of, so how do you compute the right of use asset? You look at the lease liability, you have to look at the present value of lease liability plus any payments which you made in advance, and the commencement date, the direct cost, the restoration cost, and all of that you consider. From a lease liability perspective, you consider the fixed payment, the in substance fixed payment, any variability linked to an index or a rate, if there are any residual value guarantee, if there are exercise price, all of that you consider. If there are penalties for termination, all of that you need to consider in terms of determination of your lease liability. Now, termination penalty, remember, you will only consider if you believe that there is going to be a termination, otherwise you don't. And then from a P&L perspective, on a subsequent basis, amortize the right of use asset, record the interest cost on the liability, and impact that on the accumulated depreciation. From a liability perspective, interest cost, and then whatever cash you are making the payment, you're going to credit the lease liability, and that results into reduction of lease liability, debit the lease liability, credit the bank with the amount of cash which you're paying, and you follow the cost model, and subsequent accounting, you may follow the revaluation, but again, revaluation model is going to be extremely rare, right? And then you're going to look at the impairment test under Ind AS 36 model, and impairment test can be relevant because you could have a situation that where you landed up with an asset which is then you're not able to generate economic benefit. Then you compare the carrying value with the recoverable amount, but you do it only when there are impairment triggers, right? You don't do it just like that. If there are triggers, and then only you need to test it for impairment under Ind AS 36 model. Okay, so now I'm going just to take a brief pause, and then we're going to talk about impact of other Ind AS as well.